Hey, I've been seeing all this buzz about gold prices hitting over $4,000 an ounce. It's crazy high, right? Makes me wonder if it's too late to even think about buying some, or if this is just the beginning. What actually drives gold prices to these record levels anyway?
Oh, that's a great question to kick things off. Gold's been on a wild ride lately, hasn't it? Let's break it down simply. At its core, gold prices climb because of supply and demand, just like how concert tickets get pricier when everyone's rushing to buy them. But with gold, it's not just about how much is mined from the ground. It's tied to bigger stuff like world events. For example, when there's tension between countries, think trade wars or actual conflicts, people flock to gold because it's seen as stable. Remember back in 2022, when Russia invaded Ukraine? Gold jumped about 18% that year as folks worried about global shakeups. It's like gold becomes that reliable friend you turn to when everything else feels shaky.
So geopolitical tensions? Like wars or political stuff make people buy more gold? But isn't there plenty of gold out there? Why would supply be an issue?
Exactly. You're spot on with the tensions part. It's all about fear driving demand up. On the supply side, it's not infinite. Mining gold is tough and expensive, and new discoveries aren't happening as fast as they used to. Plus, central banks in places like China and India have been buying tons of it lately. China alone added over 300 tons to its reserves in 2023, pushing demand higher. But here's another big driver: inflation fears. When prices for everyday things like groceries or gas start rising fast, money loses value, right? Gold holds its worth better because you can't just print more of it like paper money. It's like if you had a piggy bank that didn't shrink when everything else got more expensive. Back in the 1970s, during that oil crisis and high inflation, gold shot up from about $35 an ounce to over $800 by 1980. People were scared their dollars wouldn't buy as much tomorrow.
Okay, that makes sense. With inflation, like gold protects your buying power. But gold's at $4,000 now. It feels so overpriced. Why would anyone buy it at this point? Isn't it just going to crash?
The overpriced worry. That's a common one, especially for someone your age starting to think about money. It's not about chasing the high. It's about understanding why it's climbing. Think of it like a seesaw. When the stock market or economy wobbles, gold often goes up because investors pull money from risky stuff and park it in gold. Demand spikes, supply can't keep up quickly, and bam, prices rise. Geopolitical stuff adds fuel. For instance, with ongoing Middle East tensions, as of this month in 2025, gold broke that $4,000 barrier just last week on October 15th. According to market reports. And don't forget the money supply angle. When governments print more cash to stimulate economies, like during the 2020 pandemic, it dilutes currency value, making gold more appealing. I remember a buddy of mine in his 20s who started buying small amounts during the 2008 financial crisis. He wasn't rich, but he saw gold as a hedge, and it paid off when prices doubled in a few years.
Whoa, so it's not just random. These are real pushes like supply shortages from mining limits, fears of money losing value, and global drama. That 2025 spike on October 15th ties right into current news. But if it's so driven by fear, why not just stick with stocks that might bounce back quicker?
You're thinking ahead, which is smart. Stocks do recover, but gold's appeal is in not moving in lockstep with them. It's uncorrelated, meaning when stocks tank, gold often holds steady or rises. That's the safe haven vibe. But yeah, the overpriced feeling, it's valid, but look at history. After hitting highs in 2011 around 1900, it dipped, but then climbed again with new events. The key is those drivers persisting. Inflation's been sticky lately, with U.S. rates hovering around 3 to 4% this year. And central banks are still hoarding gold. Russia and Turkey added big chunks in 2024. It's like planting a tree. You don't buy at the peak for a quick flip, but because the soil's fertile for growth.
All right, I'm getting it. Demand from banks and fears keep pushing it. That anecdote about your friend in 2008 helps, makes it feel real. So, if these factors are still in play, maybe it's not too late. But hasn't gold peaked like this before and then totally crashed? How do we know this time's different?
You're right to bring up those past peaks and crashes. Gold has had its ups and downs, like in 2011 when it hit about 1900 and then fell over 40% by 2015 as markets stabilized. But each time is shaped by unique circumstances, and today's mix of inflation and tensions feels different, more sustained. To your point, though, this ties into why gold shines as a safe haven when markets get shaky. See, during economic wobbles or stock dips, people turn to gold because it hedges against uncertainty. It's like that sturdy umbrella you grab when storm clouds gather, even if the rain doesn't always pour. It preserves your money's value when everything else feels risky.
A hedge against uncertainty? Like it protects you from losing everything? But stocks usually bounce back pretty quick after a drop. Remember how the market recovered from the 2020 crash by 2021? Gold just seems kind of boring compared to that excitement. Why bother with it?
Boring? That's actually gold's superpower. It's not about the thrill, it's about reliability. Yeah, stocks can rebound fast, like they did post-2020 with all that stimulus money flowing in, turning a 34% S&P 500 drop into gains by year's end. But gold isn't trying to race them. It's uncorrelated with equities, meaning it often zigzags the opposite way. When stocks tank due to recessions or bubbles bursting, gold holds steady or climbs because investors flee to safety. Think of it like diversifying your lunch. You don't put all your snacks in one basket that might spill. Gold is that extra apple that stays fresh no matter what.
Okay, uncorrelated means it doesn't follow the stock market's moves? That makes sense for not losing everything at once, but how does it actually preserve value? Isn't it just a shiny rock that doesn't pay dividends or anything?
Spot on. Uncorrelated is key. Studies show gold's correlation with stocks is often low, around 0.1 to 0.3 on a scale where 1 means they move together perfectly. As for preserving value, gold's been money for thousands of years because it's scarce and can't be inflated away like paper currency. When economies heat up with too much money printing, like the US did trillions during the pandemic, inflation erodes what your dollars can buy. Gold, it keeps its purchasing power. For instance, in the hyperinflation of Weimar Germany in 1923, people traded wheelbarrows of cash for bread, but an ounce of gold could still buy a suit or a nice meal, just like today. It's not about dividends. It's about not waking up poorer because the world's gone haywire.
Whoa, that Weimar story is wild. So gold acts like a value anchor when money goes nuts, and being uncorrelated helps during crashes. But if stocks recover fast, isn't gold just sitting there not growing as much? Feels like I'd miss out on bigger gains.
The missing out fear. It's real, especially when you're young and stocks seem like a rocket ship. Gold isn't boring, it's strategic. Sure, over long stretches, like the last 50 years, stocks have averaged about 10% annual returns, while gold's around 8%. But gold shines in the rough patches. During the 2008 financial crisis, the S&P 500 plunged 57%, but gold rose 25% that year. My niece, who was about your age then, watched her parents' stock portfolio shrink, but the little gold coins they had tucked away held value and even grew, giving them peace of mind to ride out the storm. It's not about beating stocks every time. It's about balance, a safe haven that lets you sleep at night when markets shake, preserving wealth so you can jump back into risks later.
That 2008 example hits home. It's like having a backup plan. So gold's not exciting, but it's smart for tough times, hedging uncertainty and keeping value when stocks dive. I get why people buy it now with all the market fluctuations, but even if it's a safe spot, how can I tell if this rally's got legs or if it's about to fizzle?
Great pivot. Knowing if it'll keep going boils down to watching a few key signals, like economic clues and buying trends. For starters, central banks are still snapping up gold. In 2024 alone, they bought over 1,000 tons globally, the highest since records began, signaling they see ongoing value. Then there's inflation data. If it stays above 2%, like the 3.2% U.S. rate reported last month in September 2025, that supports higher gold prices. Technical charts help too. Right now, gold's in an uptrend, breaking resistance levels without major pullbacks.
Central banks buying that much? That's huge, like they're betting on it long term. And inflation sticking around would keep pushing it up. But aren't predictions just educated guesses? What if something unexpected happens?
Absolutely. Predictions aren't crystal balls, but they're based on patterns. Look at geopolitical signs. With elections heating up and tensions in places like the South China Sea, as of this October 2025, any escalation could spike demand. Economic indicators, like a weakening dollar, it's down 5% against major currencies this year, make gold cheaper for foreign buyers, boosting prices. I recall in 2019, before the pandemic, similar signs like rising debt levels hinted at gold's climb from $1,300 to over $2,000 by 2020. It's about spotting trends, not gambling.
Patterns from history, like that 2019 lead-up, make it less guesswork. So watching banks, inflation, charts, and world news could signal if it's continuing. That eases the risk a bit. But as a team, is this even something I can dip into without a ton of cash?
That's a sharp question. Figuring out if gold's rally has more room to run, or if it's peaking, is like reading the weather before a big game. You look for clues to decide if you play or sit it out. Let's dive in. One big sign is central bank buying. These are the big players, like governments stocking up on gold for their reserves. In 2024, central banks worldwide bought over 1,000 tons, the most ever recorded, with countries like China and India leading the charge. That's a strong hint they expect prices to keep climbing, especially with ongoing global uncertainties. Then there are economic indicators, like inflation rates and interest rates. If inflation stays elevated, say above the 2% target, as it's been hovering around 3% in the U.S. this year through September 2025, gold tends to benefit because it fights that value erosion. Remember, just last week on October 15th, gold surged past $4,000 amid fresh inflation data and Middle East headlines.
Central banks buying that much sounds serious, like they're preparing for something big. And inflation sticking around would definitely push prices up. But how do technical charts fit in? Aren't those just squiggly lines that anyone can interpret differently?
Squiggly lines, yeah. But they're more like a roadmap showing where the price has been and might go. Technical charts look at patterns, like support levels where the price bounces back, or resistance where it struggles to break higher. Right now, in October 2025, gold's chart shows a solid uptrend, having broken through the $3,800 resistance without a major dip, which suggests momentum. Analysts use things like moving averages, say the 50-day average crossing above the 200-day one, which happened back in early 2024 and signaled the start of this rally. It's not foolproof, but combined with real-world signs, it helps. Think of it like checking a trail map before hiking. It doesn't guarantee no rain, but it spots the clear paths.
Okay, uptrends and moving averages. That sounds technical, but kind of makes sense, like patterns in a video game level. So, if banks are buying, inflation's up, and charts look good, the rally might continue. But predictions feel like total guesses to me. Isn't it too risky to bet on that, especially when I hear stories of gold crashing after highs?
The guesswork objection. It's valid, and yeah, no one's got a crystal ball. Markets can surprise us. But these signs aren't wild guesses. They're based on data and history. For instance, during the 2010-2011 rally, similar indicators like rising central bank purchases and inflation fears pushed gold to $1,900 before a pullback. But those who watched the signs sold at peaks or held through. Today, with the dollar weakening, it's dropped about 5% against a basket of currencies in 2025 so far. That makes gold more attractive globally, supporting continuation. Risk is always there, but you mitigate it by not going all in. It's about informed decisions, not gambling. My younger cousin, a college student in 2020, started tracking these same signals on free apps and dipped in small during the pandemic rally. It wasn't a fortune, but seeing those patterns play out built his confidence without big losses.
So it's informed guessing, backed by data like dollar weakness and past rallies. That 2011 example shows it can drop, but watching signs helps time it better. Reduces the risk a little, I guess. What about stuff like unemployment or GDP? Do those economic indicators play into gold's future too?
You're connecting the dots nicely. Yes. Broader economic indicators matter a ton. High unemployment or slowing GDP can signal recession fears, which often boost gold as a safe bet. For example, if U.S. GDP growth dips below 2%, like forecasts suggest it might in Q4 2025 due to trade tensions, investors pile into gold. Pair that with geopolitical stuff, ongoing issues in Ukraine and new flares in the Taiwan Strait this month, and you've got sustained demand. It's like ingredients in a recipe. One alone might not do much, but together they bake up a strong case for the rally continuing. Just last year, in 2024, when GDP slowed in Europe, gold gained 15% as fears mounted.
Recession signals like slow GDP would make sense for more buying. And mixing in geopolitics, yeah, with all that's happening now, it feels like the rally could keep going. But if predictions are still risky, maybe I should think small. As someone without a huge allowance, how would I even start?
Small is smart. That's how most folks begin, and there are easy ways to test the waters without breaking the bank. But let's not jump ahead. First, consider how these signs tie back to your original worry about it being too late. If central banks keep buying and indicators stay positive, this might just be getting started, not ending.
True, those signs do make it seem like there's more upside. I'm starting to see how to gauge it without feeling totally in the dark. Still, the risk thing nags at me. It's exciting, but I don't have piles of money lying around to experiment with.
Hey, that risk nagging you is totally normal, especially when you're not swimming in cash yet. But here's the good news. You don't need piles of money to start with gold. It's more accessible than you think, like dipping your toe in a pool before jumping in. Let's tackle that too expensive worry head on. For teens like you, maybe saving from a part-time job or allowance, there are simple ways to add a bit of gold to your savings without buying a whole bar or anything fancy. Think ETFs. That's short for exchange-traded funds. Basically baskets of investments you can buy shares in, like the GLD fund that tracks gold prices. You could start with as little as $50 through a brokerage app on your phone, and it moves with gold's value without you having to store the actual metal.
ETFs sound kind of like buying a piece of gold without the hassle, but I thought gold was all about physical stuff, like coins or bars. Wouldn't that be better for actually owning it?
You're right. Physical gold has that cool, tangible feel, like holding history in your hand. Coins are a great entry point. You can buy something small, like a 1/10 ounce gold coin, for around $400 or so right now in October 2025, depending on the spot price. Places like reputable dealers or even online sites let you start there, and it's yours to keep in a safe spot at home. But yeah, ETFs make it easier and cheaper to get in. No storage worries. I had a teen neighbor who began with a tiny coin his grandma gave him for his 16th birthday. Back in 2015, he added to it slowly, and now it's worth double what he started with. It's about building habits, not going big right away.
A small coin for $400? That's still a chunk, but I guess if I save up for my weekend gig, it's doable. What about this fractional buying thing? Does that mean I can buy even smaller bits?
Exactly. Fractional buying is a game changer for folks without deep pockets. Some apps and platforms let you purchase tiny fractions of an ounce, like 0.01 ounces, for just a few bucks. It's stored securely for you, and you own that piece digitally, backed by real gold in a vault. Think of it like splitting a pizza with friends. You get your slice without buying the whole pie. This exploded in popularity around 2020 when apps like Vaulted or even Robinhood started offering it, making gold feel less like a rich person's game. No need for real money first. Start with what you have, maybe $10 a month, and watch it grow as prices move.
Fractional sounds perfect for me. Like, I could use birthday money or something small. But isn't there fees or risks with these apps? And do I need a bank account or what?
Fees are there, but they're usually low, like 0.5% to 1% per year for storage or management in ETFs or fractional setups. Compare that to stocks, and it's similar. Risks? Well, with reputable ones regulated by folks like the SEC, your gold's safe from theft, unlike hiding coins under your mattress. You might need a linked bank account if you're over 18, but for teens, some allow parental oversight or even junior accounts. My own kid, when he was 17 in 2022, used an app with my help to buy fractional gold. We started with $20 from his chores, and it taught him about markets without any drama. It's practical, builds your savings diversely, hedging against those shaky times we talked about.
Low fees and secure? That eases my mind. So, ETFs for easy tracking, coins for the real thing, and fractional for tiny starts. But what if I want to sell later? Is it hard to turn it back into cash?
Not hard at all. Liquidity is gold's friend. For ETFs, you sell shares just like stocks through your app, often same-day cash. Physical coins? Take them to a dealer or pawn shop, but check for fair prices. Online marketplaces make it quick too. Fractional? The app handles selling your portion instantly. Remember that story from the 2008 crisis? People who had small gold holdings sold bits when needed, turning it into cash for bills while stocks were down. It's flexible, fitting right into a team's savings plan, maybe alongside a high-yield savings account or index funds for balance.
Okay, liquidity means easy to sell. Got it. That makes it less scary. I can see myself starting fractional with my next paycheck, just to try. But honestly, it still feels pricey overall. Do I really need gold when I could just save in a bank?
The need real money first vibe is spot on for building basics, but adding gold isn't instead of saving. It's part of it, like sprinkling in some spice to your meal. Bank's great for safety and interest, but gold adds that hedge against inflation we discussed. If prices rise, your savings buy less, but gold might hold or gain. Start tiny. Even $5 a week into fractional gold builds over time. Think of it as your personal treasure chest growing quietly. A friend of mine's daughter, 15 years old in 2023, began with gift card money into an ETF. By now, it's up 20%, teaching her more than any class.
Spice to the meal. Yeah, diversification without ditching the basics. That teen story motivates me. Small starts can add up. I think I've got a plan now. Check out a fractional app, maybe grab a coin later when I've saved more. This whole gold thing doesn't seem so out of reach anymore.
You're nailing it. Small, smart steps turn curiosity into real knowledge. Remember, it's not about getting rich quick. It's about understanding how gold fits into protecting what you built, especially with prices where they are now. Keep that warm spot for it in your savings, and you'll be set for whatever comes.
Totally. I've learned a ton about why gold's spiking, how it protects during shakes, spotting if it'll keep going, and now actually starting small. Feels empowering, not overwhelming. Thanks for breaking it all down. I'm ready to give it a shot wisely.